Thanks for inviting me. It's a great pleasure to be able to speak to you. So what I want to do is to talk about trust. I've added also now forecasting and monetary policy. This is work that I've done jointly with my co-author Jume G from University College London. So the objective of my presentation is the following. I want to analyze how trust affects monetary policy transmission. And in order to do so, I use a behavior macroeconomic model that starts from the proposition that agents have cognitive limitations that prevent them from having rational expectations. They only understand small bits and pieces of the complexity of the world. And as a result, they use simple rules to guide their behavior. Rationality is introduced through a selection mechanism, that is, agents evaluate the performance of these rules continuously, and they are willing to switch from one rule to the other depending on how well these rules perform. So what I'm going to do is to quickly present a model and then go into the analysis that I want to present to you, which is trust and forecasting. So the basic model structure is very traditional, New Keynesian, with an aggregate demand equation that can be derived from utility maximization, an aggregate supply, a New Keynesian Phillips curve, and a Taylor rule. So that's basically the minimal canonical model that I'm using, right? But instead of having rational expectations, I introduce heuristics, both for output forecasting as for inflation forecasting. And I assume the simplest possible setup of only two rules. Of course, we have done more work with a battery of rules, but here just two rules. One I call a fundamentalist rule, which is that agents, when they see the output gap above the equilibrium, will expect it to return to equilibrium. And an extrapolative rule, which is just extrapolating the past. So the first one can be called a negative feedback rule, and this is essentially stabilizing. The second one is a positive feedback rule, that is potentially destabilizing, and it is the interaction between these two rules that creates the complexity in a model like this. For inflation forecasting, I assume something very similar, but here the fundamentalist rule is actually the rule that says that agents trust the central bank. The central bank has announced an inflation target and say 2%, and therefore they will use 2% as their forecasting rule. So these are the guys who trust the central bank. Those who don't trust extrapolate. They just extrapolate the past. So the model then has already one variable here, namely the fraction of agents that use the forecasting rule, the target inflation as the forecasting rule. We have a measure actually of trust in the market. Now, these are the only two equations that I will show you. The market forecasts, right here, ET, YT plus 1 is the market forecast for the output gap, is a weighted average of these two heuristics, the fundamentalist F and the extrapolative one. And the alphas are just the probabilities that agents will use either fundamentalist or an extrapolative rule. And I do something similar for forecasting of inflation, where the betas are the probabilities that agents use one of these two rules. And these probabilities are determined endogenously in the model by a performance criterion. Agents will compute how well these rules were performing, and then will be willing to switch from one rule to the other, right? And this is the core of this model. I define animal spirits. So there is in the model a market sentiment index, which measures optimism or pessimism. That can only also be derived from these fractions, alphas, that I just showed you. And this index of optimism or pessimism varies between -1 and +1. +1 means that all agents expect an increase in the output gap in the future. And -1 means they expect a decline in the output gap. So and I call that animal spirits. And this thing drives much of the model. So calibration of the model, I'm not going to say much about it. Let me just say the following about what kind of model we have here. This is a model that produces endogenous business cycles. So business cycles are not necessarily the result of exogenous shock. Of course, exogenous shocks may also lead to to business cycle movements, as they do typically in mainstream models. But here we have endogenous business cycles that are driven essentially by the dynamics of animal spirits. And one characteristic of this model is that even if the shocks are IID, normally distributed, the output gap is non-Gaussian. The distribution of the output gap is non-Gaussian with excess kurtosis and fat tails. In other words, this model predicts that we should expect booms and busts, even if there are no booms and bust shocks from outside, if there are no large shocks from the outside. So it's dynamics that is produced endogenously and is the result of movements in animal spirits, say movement of optimism that leads to a collective effect of the views of agents get correlated so that this degenerate into a boom, an unsustainable boom, and then a bust. So these are just a few aspects of the model that I wanted to highlight before I go further. And here it is. So I define trust in two ways. There are two dimensions to trust in this model. One is trust in the central bank, which is measured by this beta FT, which is the fraction of agents that use the central bank's announced inflation target as their forecasting rule. And the more agents do that, the more that we can say that they trust the central bank. And then the second dimension of trust is trust in the future, which is measured by these animal spirits, degree of optimism and pessimism. How well do you evaluate the future? So this is so there are essentially two dimensions to trust in this model. So now the next step is to analyze the importance of trust in a transmission of shocks. And I will focus on supply shocks because that seems to be also the major shocks that we have today. And I will also focus on large shocks, right? And large will be here 10 standard deviations. Actually, the pandemic shock came very close to a 10 standard deviation shock in the output gap. And I don't know what the Ukraine shock means, but also it's a large shock. I will say a few things about sensitivity to these shocks, right? I will also contrast briefly with demand shocks. So the way I go about is to compute impulse responses to that supply shock. Now, this is a nonlinear model. So as a result, each impulse response depends on initial conditions. And you get a different trajectory for the same shock depending on the initial conditions. So what I do is to compute 1,000 impulse responses each time for a different realization of stochastic shocks in the model. Right? And so it's impulse responses also are expressed here as multipliers. So let me immediately show you some of the results here. I show you the impulse responses of a large supply shock on output, inflation, and the interest rate. And you can see large variation in these impulse responses, but more importantly, there seems to be a bifurcation, two trajectories. I've colored them differently. One is the green trajectories. These are I call it a good trajectory. And then the black is a bad trajectory. So for the same shock, but different initial conditions, we can get stuck in different type of trajectories. Now, within each of these trajectories, there is also a lot of variation, but there is a clear divergence between the two. And that's the case for output, where the bad trajectory leads to a much bigger decline in output gap. There is also something similar in inflation, where inflation gets stuck higher and takes more time to go back to equilibrium, and interest rate responses have a similar feature. So that's a very important characteristic of this model. Another way to see this is to take a cross-section of the previous impulse responses at one period of time. So I take 12 periods after the shocks. So I've calibrated the model so that a period is about a quarter. So this is like, say, 3 years after the shock. And here I show the frequency distribution of, I call it the short-term output response and inflation response. And you can see it's bimodal, right? You have here observations 12 periods after the shock in the domain with a large decline in output, and then observations around a much smaller decline in output. This is the good trajectory. This is the bad trajectory. And something similar happens with inflation. And note that in the bad trajectory, the central bank is forced to increase the interest rate much more than in the good trajectory, which is located here. So we have here an important result that I will interpret in a minute. But the question that arises is, why do we have these bifurcations? Why do we get these two types of trajectories, right? And here it is. It has to do with the fact that when you are in a bad trajectory, immediately after the shock, we obtain a limit solution. That is, inflation credibility is pushed towards its limit, that is zero credibility. And animal spirits are pushed towards -1, that is extreme pessimism. So the initial conditions are unfavorable, and as a result, the same shock pushes you to the extremes, and as a result, the mean reverting processes in forecasting are switched off, right? Because inflation credibility has dropped to zero. Nobody believes the central bank anymore, and therefore, inflation forecasting is just extrapolation. And something similar happened with the output gap. And that, of course, introduces a destabilizing dynamics. It allows the mean reverting processes are switched off. And so you only have the extrapolating forecasting, which is inherently destabilizing and pushes you into a bad trajectory, right? So that's the essence of why we get this. Let me say a few things about the nature of uncertainty in this model, and this may have, if you believe that this model is a good representation of reality, may have some implications also for policy making. We can see that the frequency distribution of the impulse responses show a big departure from Gaussian distribution, right? The mean and standard deviation are not informative about the nature of uncertainty. So in order to illustrate this, what I did is to compute in the same model here, the mean impulse responses, output and inflation, and also two standard deviations above and below, right? This is what is typically done in mainstream models where you show impulse responses and some variation around it. But it's clear that when these things are non-Gaussian, this is not informative at all. In fact, it is misleading because there are almost no observations around the mean impulse response of output, right? You are one of the trajectories, good or bad, and the same is true for inflation. So the whole idea also that agents can know the distribution of shocks makes only sense if these shocks are normally distributed. It makes no sense in a non-Gaussian world such as the one that is represented here. Nobody knows the distribution of great disturbances such as the pandemics and wars, right? I have not met anybody who was actually capable of describing the distribution of these shocks. But what we do know is that these shocks are not normally distributed and that they will produce non-Gaussian outcomes. So one way to look at this is to say, well, let's introduce the notion of ambiguity. The distribution of these impulse responses is ambiguous. There is a strong ambiguity about the effects of these shocks because the same shock can lead us into different universes of adjustment, right? And now note the following: the main business of macroeconomists has been to produce conditional forecasts. This is what impulse responses do all the time. You have a shock and you ask the question, what's going to happen if you have this or this particular shock? And then we produce mean responses and a band of uncertainty around the mean. And these are unreliable exercises, right? We cannot rely on this. And so instead of in conditional forecasting, we have to think in terms of scenario, a good scenario, a bad scenario, maybe probably more. So in the end, I have sympathy with the central banks that spectacularly failed to forecast inflation after the pandemic and the Ukraine shocks, right? They just didn't make the right forecast. And actually, almost nobody made the right forecast. But I have sympathy with the central bank because how could they know in which scenario they would end up with, right? In real time, it's very difficult, if not impossible, to find out which scenario. And then a case could be made, right, that we could have gone into a good trajectory, right? It may look like now that we are in a bad trajectory, but the jury is still out. Now, let me say a few things about the trajectories and trust. How are these trajectories related, connected to our measures of trust here? And I'm going to show you both the trust in the central bank, credibility of the central bank, and my measure of optimism, pessimism, animal spirits. Here is the trust and inflation credibility. So this looks a little bit weird. Let me explain you what I'm doing here. The black relates to the bad trajectory, the green to the good trajectory. So here I show you on top left, I show you inflation credibility in the bad trajectory. And now note the following, the shock is introduced in period 100, and before I have 1,000 simulations of impulse responses, and therefore also 1,000 little lines of inflation credibility, right? These betas that I showed you earlier. And prior to the shock, they move around. But then, as you can see, when you have a shock in period 100, these betas, which measure inflation credibility, drop to zero. Everybody has lost confidence in the central bank, right? And this takes a while to recover here in the bad trajectory. In the green trajectory, we don't have something similar. Trust is not lost in the central bank, right? But it is in the bad trajectory. And something similar happened with animal spirits. You have a shock in period 100 and pessimism set in. And this is a very strong feature in the bad trajectory. It's not so in the good trajectory, right? Now you may ask, so you can see that the ending up in a bad trajectory is correlated with a situation where agents have lost confidence, both in the central bank and confidence into the future, right? You may ask the question, where does that come from? Well, it comes from the initial conditions, right? You get into a bad trajectory if the initial conditions are bad. And what does it mean, bad initial conditions? Well, it means that inflation expectations are high initially. So actually, in this model, it means inflation expectations are above the target. And there is pessimism to start with. And these bad initial conditions then make it possible that a large negative shock pushes the system towards the limit of credibility and extreme pessimism. This is not the case when the initial conditions are favorable. Favorable means here you have low inflation expectations. There is optimism. You have the same supply shock. But since the initial conditions are favorable, the system is not pushed towards the limits. And as a result, the mean reverting processes continue to function, and you are on a benign trajectory, and you get out of the mess quicker than would otherwise be the case in the bad trajectory. So the favorable initial conditions work as a buffer, preventing large shocks from hitting the boundaries and preventing a collapse of trust. So if initial conditions are right, are benign, then the same initial shock will have very different transmissions compared to the situation where the initial conditions are bad to start with, right? And when trust is there, then you can return in a more smooth way towards equilibrium. Here's a way to show this. Here I show the initial conditions on the horizontal axis. Look at the left-hand side graph here, inflation expectations. I have normalized the inflation target to zero. So favorable initial conditions are negative values here, right? That means that agents expected inflation below the inflation target. So this was a situation that we had prior to the shocks, the pandemic, where inflation and inflation expectations were very low, lower than the inflation target. And then 12 periods afterwards, you end up with an output gap that is relatively mild. It has not declined much, right? While if inflation expectations are very high, your output gap tends to move to a very low level. So you can see that inflation expectations have a very strong predictive power to tell you in which in which particular trajectory you went up. And there's something similar happens here with inflation expectations. Negative demand shocks, I just want to say one thing about this. We also do negative demand shocks, large negative demand shocks. The contrast between demand shocks and supply shocks, as you know, has to do with the fact that in a supply shock, you have a dilemma problem for the central bank, right? If it wants to fight inflation, it makes a recession possible. If it fights the recession, it cannot reduce inflation, something you don't have with negative demand shock. And as a result, the central bank is not, we don't have the same kind of bifurcation, a little bit, but not much. And the central bank actually doesn't lose trust where a demand shock is, because the central bank is perceived to be capable of dealing with inflation and output gap. And so the negative demand shocks are much less problematic, right? I did some, for the sake of the time, so I did some sensitivity analysis varying the size of the supply shock. And you can see that when the supply shock becomes less pronounced, the 1, 3, 5, these are standard deviations, we get less of this bifurcation, but still a lot of variation. And by the way, non-Gaussian behavior of the transmission mechanism. The power of stabilization of output, stabilization on a supply shock, what I did was the following. In the previous evidence that I gave you, I assumed in the Taylor rule a C2 parameter, which expresses the intensity of the central bank to stabilize the output gap of 0.5. Now I increase it to 2, and I check what that does to the transmission, right? And here I show you on the right-hand side, this is what I call normal stabilization with C2 equal to 0.5. This actually was the result I showed you earlier, but now I contrast this with strong stabilization. I have a central bank that is very much geared towards stabilizing the output gap, and you can see that bifurcation is still there, but the effect on the negative effect on the output gap is reduced considerably, but there is a price to pay, which is that the success in reducing the decline in output gap comes with a much more protracted inflation. Inflation gets stuck in the system much longer, right? Both in the bad trajectory, the black lines here, but also in the good trajectory. So there's a price you pay. We know that, right? This is the traditional trade-off that you have when you do these things. One last thing what we did was to say, well, maybe we can alleviate this conflict, this trade-off, by raising the inflation target, right? So here it is. On the right-hand side, you have the inflation target 2%, which is the simulation that we used that I showed in the presentation. And then on the left-hand side, I have an inflation target equal to 4%, right? And you can see that this has some attraction, right? The attraction is that, yes, you can reduce the negative effect of the same supply shock. And look at inflation now. Actually, if you are in the good trajectory, there is no loss in terms of more inflation. And you can argue that if you are in the bad trajectory, yes, you will go to a higher steady state inflation, but you go there relatively quickly. So you have a new environment of a higher inflation, and you have alleviated the trade-off that the central bank faces under supply shocks. So that's the advantage, and maybe the window of opportunities for central banks today, that is, well, let's raise the inflation target so as to reduce the potentially negative effect on output and reduce the risk and the intensity of a recession. Conclusion, let me say just a few things about the relevance of all this. In the 1970s, we had large supply shocks, right? Preceding these large supply shocks, actually, we had already, during the second half of the 60s, an inflationary buildup, right? Expectations of inflation had already built up. So the initial conditions in the 1970s actually were quite bad. And this explains why it took such a long time for the world economy to recover from that shock in those days. The COVID supply shock of 2020 was a huge supply shock, right? Yet the year afterwards, we had a recovery. Right? The initial conditions were very favorable, and our model predicts that, well, this may explain why the recovery was so quick. There was still trust in the central bank, and optimism had not been totally eliminated. And a quick recovery came about in 2021. Unfortunately, then we had a new shock in 2022, the Ukraine shock. And now the initial conditions are less favorable, right? So that the risk is that we are in a bad trajectory with a strong decline in trust, high and long-lasting inflation, deep recession, and very high interest rates. So that's the good news that I wanted to tell you. And of course, also in this bad trajectory, great difficulties for central bankers to make reliable inflation forecasts. Thank you for your attention.